you saw that the mortgage rate is the highest it's been in over 20 years.
Yeah, since the 90s. Yeah.
7.09%. And the rates I'm seeing in Florida and other places, mortgages are like 8%. Well, if it's going to cost you 8% to buy a new house, and it used to be 3% a couple of years ago, you're not going to be able to afford to buy that same level of house. And you can't afford to sell your current house and buy a new one because your current house is financed at 3%. You're not going to give up that mortgage to trade into an 8% mortgage. So we're already seeing a huge reduction in the number of transactions in residential real estate. And so that means that we're not seeing a lot of fresh marks in terms of where prices are, but that doesn't mean the valuations haven't gone lower. I think that as this washes through the system, you could see a big correction in the values of residential real estate, which is most people's main asset. So I think there's a big risk factor there. The other big risk factor is on the commercial real estate side. There was an interesting article in the Wall Street Journal about distress funds are forming in anticipation of a lot of commercial real estate projects basically going under. So the vultures on Wall Street are going to be looking to scoop up these projects. I think the really interesting thing about commercial real estate right now is multifamily. Until now, the conversation has all been about office space. And we know that office space is impaired because of the high vacancy rates, that this sector just hasn't come back the same way
from home
since COVID. Right, exactly. But now we're starting to see real distress in the multifamily sector. Now, why has this happened? Because multifamily is full. There's no vacancy problem.
Yeah, it's hard to get a home, and more people would be renting if mortgages are high. So
the
explain
problem is
why
not on the demand side. The problem is in the capital stack. So let me describe the problem of what's happened here is, let's say that you are a real estate developer who bought multifamily. You bought it at a certain price level. Let's say you financed it 2/3 with debt. You now need to go out and refinance that project because let's say you did a value add. Let's say you basically did some improvements to it. That means you didn't put long-term debt on it. You can't put long-term debt on a project that's not stabilized yet. If you want to do value add work to it, you get what's called a construction loan for 2 or 3 years. So there's a lot of real estate developers who need to go out right now and finance these projects that they bought. And they bought these projects at the top of the market. So let's say you're going out now to refinance. First of all, the rates are much higher. You're looking at paying 8 or 9% instead of the 3 to 4% that you had penciled in your model a couple of years ago. Moreover, there's another problem, which is potentially even worse, which is loan to value. You had basically gotten 2/3 loan to value a couple of years ago, but values were much higher. Now values are lower because, again, multiples have shrunk as interest rates have gone up. And so the amount that you can finance is much lower. So you either have to top that off by coming out of pocket with your own equity, or you have to go to one of these mezzanine funds. So now there's these mezz funds, they are total sharks, and they're going to charge you not 8 or 9%, but like 15%. So your capital stack has basically is completely upside down. You thought that you could borrow all this money really cheaply, but now it is super expensive. And this project no longer pencils, meaning you're underwater you've got negative leverage on the project. And so I think you're going to see, again, not just impaired office space, now impaired multifamily. And there is not, I think, a sector of real estate developer who is not in distress right now if they need financing in the next year or two.
Dax, what do you
get a better rate from Hesh?
Right.
David, what do you do if you're long these assets? Do you just default on them and just give them back to the bank?
One major real estate guy told me that the big guys like, Blackstone, the words he used was they are throwing their keys at the bank, meaning they are so underwater, they're not even going to bother trying to figure out a workout. They're just going to give the key. They're just going to say to the bank, you own this asset now, and they're going to move on to the next fund.
There's actually,
that was his take, at least. That was his take.
You sent a tweet to the group chat about the last line of hope, which was called a hope note, which is where one of these mezz financiers just takes your property, and then if they happen to hit your high water mark again later on, that you would get some, idiot insurance and get a little taste of the sale. Chamath, you had a tweet about the housing thing. What's your take?
Well, no, my only thought around housing was that very much just supporting what Sachs just said. We're in an incredibly untenable situation, mostly because as rates go up, mortgage applications go down. And so what you're seeing is just the number of people trying to transact is very small. And so the inventory is very small. And so Sachs said it well. So I don't really have much to add, except that when you think about where this lands squarely in terms of the wealth creation that it's supposed to represent for most Americans, it's a very difficult situation.
It's frozen.
And this is, I actually think people talk about the political pressure from the White House to the Fed. And I think that this actually is probably a very powerful lens with which to look at it. And the reason is because this touches all voters in every state, across all political lines. And I think when people talk about, is the economy doing well or is the economy not doing well? And as a result, where are your political leanings? I think something like this actually represents a much larger percentage of how people represent whether they feel they're doing well than any other thing. Even earnings, quite honestly, because I think that a home is just such a fundamentally visceral psychological component of safety.
And
so,
a large percentage are wealth, and 60% of people own one. And the people who own one are the people who vote. So it may only be 60% of people, but it might be 80% of voters. I'm not sure.
I think that could probably very well be true. So my only point in that was just more that this could actually, if the Fed is susceptible to political pressure, I think this is the kind of thing that pressures them to move forward the point at which they start cutting and to start to let go of the release valve, just because there's just too much pressure in the system. If you let this stuff build.
There's talk of them doing a safety rate hike, doing another 25 bips at the end of the year just to be safe. And, I think one of the things we've learned here is...
I don't think the data really supports that, to be honest with you.
But they've made poor decisions this whole time. And this is not like the Fed's, impact with this tool is not like driving a car where you hit the accelerator, you hit the brake, and you get an immediate reaction. This is more like driving a train where it takes a little while to get up to speed. And if you slam on the brakes, this thing can come off the rails.
Yeah.
And that's the scary part for me.
Just to build on what Zach said, the most interesting thing about this for me is that typically we think about the Fed as being very silent in election years. They really don't try to get that involved, mostly because they don't want to seem like they're tipping in an election one way or the other. The problem that we have is that rates are at a near-term high. The 10-year is ratcheting up faster than we ever expected. It's rallied in terms of rates meaningfully more than anybody thought since the beginning of the year. And so now we're in this odd position where will the Fed cut? And why will they cut? And if they cut, will they cut sooner than they would have? If they hold on, is it that they just want the country to enter a recession, in which case they want to see, quote unquote, regime change? It's a very interesting set of financial and political politics that I don't think we've seen in recent years.
Yeah, no. Well, there's a lot of real estate developers who are literally hanging on by their fingernails, and they're hoping and praying for a rate cut. The problem they're going to have is that even if inflation doesn't rebound, even if the Fed does cut rates next year, the rate that the Fed cuts is the short rate. It's basically the Fed funds rate. That's at 5.5% right now. Even if they cut that to call it 3 to 4% next year, there's no guarantee that the 10-year rate, which is what real estate developers get financed on, will move down. Right? The 10-year rate is, what is it now, at like 4.5%?
Yeah.
Something like that. And that rate may not come down. A lot of economists are warning about this. Larry Summers warned about this because the federal government has such huge financing needs. And so just because short rates come down is no guarantee that the long rate's going to come down. And so there may not be this relief that real estate developers are looking for next year. And again, there's this wall of debt that has to be refinanced. I'll give you an example from my own portfolio. I have a building, just to simplify. The valuation.
You got a couple of buildings, but okay. You're talking about
I got
one
a building that's worth about $15 million. It's an office building, okay? There's a $9 million loan on it that is coming up to be refinanced at the end of the year. So I'm talking to the lender about rolling it over. And what they agreed to do, here are the terms. They agreed to give me $2.4 million out of the 9 secured by the building. That's it. They wouldn't roll over the 9. They'd only give me 2.4. For the other 6.6, they wanted me to post additional collateral in the form of public securities. So they basically wanted me to fully collateralize the loan. So in other words, they're adding like a margin account on top of a commercial real estate loan.
That's exactly right.
So they want me to over collateralize the building with a bunch of securities. So
why do you need a loan from them?
It's not a real estate loan. Yeah.
Right. And they want me to personally guarantee it.